Alrighty then. There we go. Good morning, everyone, or good, I guess it's about lunchtime on the East Coast. How's everyone doing today? Yeah, we're starting right at 11, so it should be good here. This is going to be the basics of binary options. I will jump right into it. I do see we have a few more people coming in, but the first few slides are always as fun disclaimers, so we have a little bit of time to go through that there. So these are going to be the basics of binary options here today. Just before I do start, if you do have any questions as we go through the webinar, throw them in the chat. I have them up on my second screen over here that I'm checking a lot right now, make sure everything's set up, working correctly. But yeah, without any further ado, let's jump on into this and learn how to trade some binary options. So this first slide, as I just mentioned, just going to be this wonderful, beautiful, sorry, a little bit tongue-tied this morning, beautiful disclaimer here. So go ahead and read this through. I'll describe it briefly while you're reading it through. Basically, trading on Nadex, just like trading anywhere, is going to involve risk. So don't go ahead, don't trade with money that you can't afford to lose, right? You want to be trading with that discretionary income. So don't trade with money you need for your rent, need for food, need for anything else. Also, I will be going ahead and placing some trades during the webinar on the demo account. These are just going to be trades to show off the functionality of trading binary option. They are not going to be any sort of recommendation on any sort of trades to make. In fact, I will be making those trades probably just at random, just to show off the functionality. So copying what I do will most likely not be a good idea. So I will give you one more second to just make sure we get this up on screen for enough time. All right, that probably should be good there. Gotta make sure you're hydrated. All right. So a little about me screen here. You're probably seeing double of my face right now, but I've been working at Nadex for about 5 years, and I've been working on our products and our platforms for the last 4 years or so. So this current platform that we're using, I was very involved in the actual development of it. I wasn't personally developing anything because I'm not a developer, but sort of working on the actual features, functionality side, and then also any new products that you've seen come through in the past few years. I've been working heavily to get those in there. And just in my own personal trading, I primarily trade equities and equity options. Been trading for about 12 years now, ever since I turned 18, and I don't trade, binary options on any live accounts, mostly because I work at Nadex, and so no Nadex employees are allowed to actually trade on their own platform. You're never trading when you're trading at Nadex. You're never trading against any employees, anything like that. We're not allowed to do that by our regulators. So that's probably enough about me. Now we can get into the nitty-gritty, the fun stuff of actually trading these options. So we have our agenda here. Quickly go over this. Just kind of see what's going to go on here. We're going to go over what binary options are, how do they work, what's the risk-reward kind of ratio proposition, how you get into a position, how you get out, how you close that position, understanding kind of how these are priced. So primarily the price, the relation of the price to the strike price, and how much time is left. Any products that you might have choices in, and then we're also going to go on to the actual platform itself, play some trades, and I'm going to show everyone sort of how to do that, what to look out for, and a couple tips, tricks, and things you just want to make sure that you're paying attention to while you're trading these sort of options. All right, so let's jump right in here. What are binary options? So binary options are going to be short-term, defined risk-reward contracts, and they're going to be based on, they can be based on really anything, because primarily they're really a yes or no question. But so they can be based on an event that's happening, something like we had CPI come out this morning. So will CPI be above or below a certain number? That is actually a contract that did expire this morning that you can trade once a month when those CPI numbers come out. But primarily what most of you will probably be familiar with trading on Nadex will be things like our underlying markets that go pretty much all day, pretty much around the clock. So things like indices, Forex, commodities, any sort of underlying market will be above or below a certain point, right? So, but it really can be on anything, because primarily what a binary option is it will this happen or won't it, right? That's sort of where the binary name comes from. It's there's only two options, right? 1 or 0, yes or no. So binary options, prediction markets, event contracts, right? These are all different words for really the same thing. It's really just a, will this happen? Won't this happen? You can either say will or won't, and at the end of the day, you are either right or you're wrong, right? There's only two potential outcomes, and you can either take the sort of yes or no side, the upward or downward, long or short. And when you're buying and you're selling or selling a binary option, your potential risk and your potential reward are going to be known up front because especially on Nadex and really everywhere that you're going to be trading these sort of things, they're what we call fully collateralized options. And it's sort of a big word just for saying that when you and the trader on the other side get into it, you both put up all the money for the option right there at the beginning. So that's that kind of full collateralization. There's no sort of margin or anything in these. It is the both you and the other side of the contract putting everything up, putting it all into sort of a pool, let's say, and then at the end of the day, either you're right or the person on the other side is right, and they get that entire sort of pool there that you've put into. So hopefully that's a very brief explanation of kind of the fundamentals of what a binary option is. So fundamentally, these are going to be made up of three components, right? These contracts, three components. So first of all, there's the underlying market. And we talked a little bit about what the underlying market could be on the last slide. So it could be something like a Forex contract, it could be euro dollar, right? Or pound dollar, it could be the US 500, it could be oil, right? That could be the underlying market. You could also have things like event contracts like we have on the exchange. So like I mentioned, it could be, will the CPI numbers be ever above or below? And fundamentally, it could really be any underlying, any yes or no question could be the underlying market. But primarily on Nadex, it is going to be those more traditional markets along with a few economic event markets as well. So there's sort of the condition or what we primarily refer to as the strike price, right? So the strike price is going to be the level on which you're predicting above or below, right? So a contract might say, for example, euro dollar greater than 1.14. That 1.14, that's going to be the strike price, right? Because that's the level you're saying, will this be above this or below this? And then the other component to this, so a contract name might be euro dollar greater than 1.14 at 3 p.m. At 3 p.m. is going to be the expiration time. That is the time component of when that needs to be either above or below this, right? Because obviously you can go above and go below any time before that, but at the expiration time, that's really when for the settlement price you're going to be wanting, that's really what it matters for that actual settlement price. That's what you're actually saying, right? Will it be above or below this at this point in time at some point in the future? All binary options on Nadex are going to have a price floor, are going to have like a price range. So the floor is going to be 0. So basically, if you get into a contract and you are incorrect in your prediction, your payout is going to be $0, and the ceiling is going to be 100. So if you get into a contract and your prediction is correct, your payout will be $100. That's not necessarily your profit, right? When we talk about profits, you're going to have to take in, or losses, you're going to have to take into account how much you paid to get into the contract. So you paid $50 to get in, and it expires in your favor at $100. Well, your overall profit's going to be 100 minus the 50 you paid to get in, which is $50. And on the other side, if you were wrong, it would be a $50 loss, right? Because you pay 50 to get in, you're getting nothing back out. So, and one important thing to remember as we go through these first few examples, because we will get into getting out early, all of these first few examples, what I'm talking about with the expiration time, the absolute 0 or absolute 100 payouts, those are in scenarios when you actually do hold the contract until that expiration time. You don't always have to do that, and we will get into that a little bit later in the webinar when it might be advantageous to exit those contracts early rather than actually holding it until that actual expiration time that's in the name of the contract. So what does the price of a binary option actually represent? And I think this is a very important point that is not immediately apparent when you first start trading these. So I do like to hit on this pretty hard here. So it's basically a true or false prediction, like we've talked about, right? The yes or no, true or false, 1 or 0 binary, right? if it's true, the option is going to settle at 100. If false, the option settles at 0. Kind of whatever that, right? The very important part of this, though, is that the price at any given time that you're seeing on the exchange or for these options can be reflected as the probability that the market thinks that that event will occur. So because these are, the way you kind of think of it, these are priced out of 100, right? So you could sort of think of it and price out of 0% to 100%. So when you take, and you can see some examples down here at the bottom, when you take the midpoint of the buy and the sell, what's being offered right now, you will get sort of, you can get the midpoint there. You can think of that as the probability that this will occur, right? Because it's priced out of 0 to 100, and the prices that are coming up in the market are sort of reflecting the probability that this outcome will happen. And so you can see here, right, we have a little example here. You have 46.25 on the sell side, 49.25 on the buy side. The midpoint of that is going to be 47.75. And so when you're getting into a buy side contract, then you can think, okay, probably about a 47% chance that this actually occurs, or 47, 48% chance that this occurs, or at least that's what the market is pricing in. That's what the market thinks that the percentage chance of this occurring. On the other side, and it's something we'll get into in a little bit here, but for the sell side, you sort of have to take the inverse of what you're being shown on the actual sell side there. So we'll get into this when we talk about how much these actually cost and how much you're paying for them. But that's why you have here the 100 minus that midpoint. So the midpoint's still going to be 50.5 and 54. That's going to be 52.25. But for the sell side, for that probability, you need to take 100 minus that midpoint, and that's going to give you the actual same probability we have here, right? The reason you do this basically, and I'll get into it in a little bit. Actually, we'll save this for a little bit, but that's the reason that there's a reason you kind of take 100 minus the sell side. You're kind of taking the inverse of that calculation. That's what you're actually paying for the contract. But that is a very important. I don't like to harp on it too much, although it is super important that what you're basically seeing there is a probability the market's pricing in that this event will occur. So moving on here, we have our risk reward relationship of a binary option. So we talked about how it was 0 to 100, right? We talked about how that's the probability inside that 0 to 100 range. The $100 total value per contract, that's going to be, again, we've talked about how it basically moves between 0 and 100. And we also talked about how these are fully collateralized. So the collateral basically is what you're putting up for a trade. And so when you actually get into a contract, you and the seller, if you're the buyer, there's a seller on the other side. If you're a seller, there's a buyer on the other side. So basically everyone that's taking a downward position in a market is met with someone that's taking an upward position in that same market. And so when you actually get in, let's say the contract's trading at, let's say there's an offer out there for $40. And so you pick that up, you say, I will buy this for $40. Well, there's someone else actually on the other side of that putting in $60, right? So as soon as you get into a contract, that whole $100 is sort of put into that pot. And then at the end, again, remember, it's when that expires, either you will get that whole $100 to you if you are correct, or if you are incorrect, that means the other side has to be correct, and the whole $100 will go to them, right? So that's sort of this concept of full collateralization of when you actually get into a contract. There's no everyone's putting the money in up front. There's no sort of unknown risk. There's no unknown reward either. You know from minute one what your risk on that contract is going to be, and that's the entirety of what you're putting into that contract. This is in contrast to basically places in which you can get trade on margin, trade with extra leverage, in which the amount you first put in is not necessarily the total amount you can lose, right? You can lose more than what you put in. That is not true at Nadex. At Nadex, all you can potentially lose is just what you actually put into the contract initially. And so you can see here, right? So the buyer's collateral, the buy side is always just going to be what the buy price is, while the seller's collateral is going to be the difference of 100 in the sell price. So 100 minus the sell price is going to be what the seller actually puts in. And the reasoning for that is basically because it kind of shows that buy side. So if it's like 45, 50, right, you're getting that midpoint pricing, but you got to remember that 45, that sell side, you're taking 100 minus that when you actually get into those contracts. And again, we will go into that as sort of an example that'll make that a little bit more clear on what we're talking about there. So this is an order ticket, and I like to put it up here so we can just go over kind of on a static deal ticket what's going on. We will look at this a little bit more when we go over later in the webinar. We go over to the actual platform itself and look what's going on in the platform. But a few things I do want to touch on because it's a little bit easier sometimes when the numbers aren't actually moving around, because obviously when you're trading on a live environment, these numbers are always going to be moving up, moving down, and it's a bit easier to kind of pinpoint what you're talking about. So first of all, we have the indicative price up here at the top left. The indicative price on any market is going to be a good indicator of where the underlying market is trading, right? On Nadex, that indicative price is going to be something that's going through the settlement calculation that we have every second. Very basically, it's just what you're seeing. We're sort of applying that settlement calculation every single second to try to give you the most accurate representation of what is actually going to be used at settlement of the contract to actually settle this. And so the indicative price that you see up here is going to have a heavy relationship to the strike price that you see here, right? The strike price and the indicative price, that's going to be the two main points that you want to look at, right? Is the indicative price over the strike price? Is it under the strike price? Where is it in relation? And then I can make a decision on, well, where do I think it will be at the expiration time. You can also see it expires in 22 hours and 7 minutes. So it's going to really clearly show you on the deal ticket when you get into the contract how much time you have left before expiration, because you obviously it always has the time in the contract, so you can always calculate that yourself, but we also put it up there very clearly for you so you know how long you have left. The other thing is these expiration times are always in Eastern time, so this is just another little helpful if you are not in Eastern time, like I'm not. I'm actually located in Chicago, so it's a little bit more helpful to actually see how much time is left rather than having everything necessarily tied to a time zone that you might not be in. Then we have the buy and the sell side, right? So we've talked a little bit about this, but these are basically what you are going to pay on the buy and on the sell side. And what you're going to see on the platform and on the deal ticket when you get in, these are going to be the best available offered prices at this buy and at the sell side. So basically what the market is saying, the best price for the buy side and the best price for the sell side. No, that's not necessarily all the prices, and I'll show you, you can kind of look at any prices underneath those, and I'll show you when you get into the platform, but for right now, what we want to be looking at is the best market price on the buy and on the sell side. Then we have our order types. We'll go over order types a little bit more, but basically there are two order types on Nadex. There's a market order and there's a limit order. And they're going to say market and limit GTC in the platform. Right now on this deal ticket, we have a limit selected. A limit just lets you actually pick the price of the contract that you want to pay for, while the market order is just going to be getting into the best available price in the market. Again, I'll go over a little bit more when we're actually in the platform, how this limit and how those market orders work and why you might want to choose one or the other. But for right now, we're looking at a limit order on this deal ticket. We have our price. So again, on the deal ticket, you're only going to be able to select a price when you have a limit order selected, and you have your size, and that's just how many of these contracts you want. The default is going to be one contract, but if you want to get into more than one, obviously that's going to raise linearly how much you're paying and your risk and your reward propositions. Next, we have the max loss, and again, something we were talking about. This is a kind of a visual representation of that fully collateralized nature of these contracts, because the price that you pay to get in, this $52.75 that we have selected right here, that's going to equal the max loss, right? Because the maximum loss you're going to be able to incur on any contract is the price that you pay to get into the contract. Now, this is not including fees. We have a fairly low fee schedule. It's $1 in, $1 out of the contract, not including fees is the maximum you can potentially lose on any contract, right? And so if you're ever confused as to kind of what you're seeing, what side you're looking on, you can go down and look, okay, my max loss, that's equal to my price. And my max profit is going to be 100 minus what I paid to get in, right? Because if I pay, let's do maybe even a simpler than this example, if I pay $60 to get in, and at the end of the contract, at the expiration of the contract, I'm correct, right? If I get on the buy side, I end up being correct. Okay, great. I get a $100 payout. That's going to be my max profit is 100 minus the 60 I paid to get in for a profit of 40. Right? So that's why that max profit is going to be sort of the inverse of 100 of your max loss. And same thing over here we see on the sell side as well. Before I do go over to the sell side, I do want to point out a couple more things. These are a little bit newer features, and I will, again, go into these more when we actually place a trade on the actual platform. But the max ROI, that's going to be your maximum return on investment. And your probability in the money is going to be what we talked about earlier, where if you take the midpoint of the best available buy and the best available sell, because they're priced out of 100, you can sort of think of that as the probability that the market is pricing into these contracts, the probability that this event will or won't occur on the other side. And the max ROI, the probability of the money, I'll show you again when we get on the platform. But those two points are very heavily connected, right? As your basically maximum ROI goes up, your probability is going to go down, and as your probability is going to go up, your max ROI is going to go down. So those are sort of inversely correlated, right? And then we have a sell side ticket here as well. And that's just sort of to show, again, you have to remember on the sell side, so you have your price here, it says 59. What you're actually paying to get into a contract on the sell side is not what you are shown on the price. It is 100 minus what you're shown on the price. So it's always very important to remember that if you see a price on the sell side and you're saying, okay, I think it's going to be below this strike line, or I think it's going to generally move in a downward direction, that's when you want to get it on the sell side. Just remember, if it says 20 on the sell side, what you're actually paying to get into the contract is 100 minus 20, so it's $80 to get into that contract for a max profit in that scenario of $20. And so when you're on the sell side, your max profit is always going to line up with what you're paying, with what the shown price, because what you're actually paying to get into the contract is 100 minus the shown price. And I know that can be a little bit confusing when, especially if you are a little bit newer, you're getting in, you're still learning these, and that's why this max loss is going to be super helpful as sort of a reference point. You can refer back to that and say, oh, okay, now I remember I have to do 100 minus the 59 that's showing here. 41 is how much I'm paying to get it. So that's going to be the deal ticket. Again, I'm going to go over a little bit more when we get into the actual platform itself. And so this is an important point that, again, I'm going to stop saying I'll get into it when we show the platform, because I'm going to get into everything that we showed on the platform. I think it's a very good teaching mechanism, but you don't have to hold these to expiration. And there's a lot of reasons that you might not want to hold these to expiration. So on a binary option, you can get into a contract. So why you might get into a buy side contract, right? Either you think that at expiration, the market is going to be above the strike. Let's say this is our strike line. You think the market's going to be up here at expiration. You want to get into a buy side. If you think it's going to be below, you want to get into a sell side. But also, if you generally think the market is going to move up, this also can be a good idea to get into a buy side. And generally, if you think the market will move down, and that can also be a good reason to get into a buy side. And it doesn't necessarily have to be above and below at expiration. And so again, I will show this a little bit more because I think it's a little bit easier to understand when you're actually looking at it in the platform. But those are kind of the two reasons. But you don't have to hold these contracts until expiration because the value of your contract that you have as you are in the trade, the value of that contract will change. It will go up and down based on some factors, based on the underlying market, based on how much time is left in the contract. And so you can exit that contract early. You do not have to wait until the end of the contract. And so this can be extremely important with things like risk management, with things like, taking your profits early, getting out of a contract early and saying, maybe this could be 100 at the end, but right now I already have a profit of like $20 instead of $50. Let me just take that $20 profit, wipe my hands on it. That's good enough for me, and walking away with that. Or on the other side, limiting your losses. You can get out of the contract early, and you don't necessarily have to lose everything you pay to get into a contract. You can get out early, and maybe instead of losing $50, you only lose $20, $30 by exiting early, right? So you can choose to exit the position early prior to expiration. I have a question coming in here. It says, will I have access to this recording after today? Yes, you will. So after today, and I'll go over this at the end as well, but all of our recordings, all of our webinars will go up on our Nadex YouTube channel. So it usually takes a few hours to go on and get up there, but yes, you will be able to go on the Nadex YouTube and see this webinar afterwards. You are also able to go on there and see a lot of different webinars we've done in the past as well as different learning materials that we have. So moving on, I'll go over this again once we get the platform. I'm saying that a lot. But this is going to be the closing deal ticket. So this is a sort of newer functionality. You've always been able to close out of your trade, but we put in a new sort of skin on the deal ticket to make it a little bit easier, a little bit clearer to see when you actually are exiting your position, what's actually going on, how much profit you are going to take or loss, and the kind of the price you got out. So in this scenario, if you're closing it at 82.25, it's telling you very clearly that you are setting a profit target to $29. And so you can either set a profit target on this, or you can actually close out at the best available market price. And that's going to show you this second screen and sort of show you, what you are actually profiting or losing at this exact time. So this is a super important part, and this is getting maybe a little bit more advanced, not too advanced though, but this is sort of the fundamentals of how these are priced. Now, one important thing to remember with all of this is that Nadex is not actually pricing any of these contracts. They are the prices that you see on the platform. They can be, traders like you can put in a limit price, and I'll show you how to do that, how to see your price on the platform. But a lot of the times they are also what is commonly referred to at Nadex and just in the industry at large as market makers. And so we do have people on the platform that do not work in Nadex, are not part of Nadex. They are kind of third-party companies, and they do provide that liquidity on the market to make sure that when you want to get in or get out of a contract, there is someone there on the other side to take that price. So that is a kind of an important distinction. So when I go over how generally binary options are priced, I am giving you a general kind of pricing model. But obviously we don't actually price these, right? So that's an important thing to understand. But still, the fundamentals of how these are priced are generally the same. So the probability of event occurring, it's constantly going to be going up and down, and that probability is based on a few different factors, right? And most of them are fairly easy to understand when you actually get into it, kind of wrap your head around it. So there's three main things that go into how a binary option is priced, right? And one important thing to remember is that just because the underlying market's moving up and down, that doesn't mean that the binary option is going to linearly move up and down with the underlying market, because while the position of the underlying market in relation to the strike price, that is one factor, and it's a very important factor. That isn't the only factor, right? And so you're not going to have a one-to-one linear movement with the binary option and with what's happening in the underlying market you're trading. But like I just said, the three main factors, that first factor is going to be the position of the underlying market relative to the strike price. And this is probably one of the more important factors, right? Because it's, the market's trading up here, the strike price is here. Well, obviously that's going to have a very large impact on how much that binary option price is pricing. Because it's, the relation of where the market is to your strike price is going to be a huge impact on, when the market thinks is going to happen at the end. If you're super far above where the strike price is, well, that contract's going to be worth a lot more, because the probability that that event happens is already pretty high, because it's way up here. It would have to move very far down to actually go against your position, basically, to at expiration be under the strike price. But the second thing that you want to look at is time. How much time is left until the expiration of the contract? This is also a very important one because, like we were just saying, right? If you have something that's super far above the strike price, so the buy side is going to be priced very high. But how much time it has to move is a very important factor because if you only have 5 minutes left, well, then there's almost no chance, almost no, there is always a chance, but there's almost no chance that it's going to go very far down and going to get below that strike price. But if you have maybe 2 days left, well, a lot can happen in 2 days. A lot more can happen in 2 days than can happen in 5 minutes. So that is going to be another very large factor is how much time is left? How much time does this thing have to move before the expiration of the contract? And then the last bit is the volatility, the fundamental implied volatility of the underlying market. Now, I'm not going to go super heavy into this one because, first of all, it's a little bit harder to quantify. It's a little bit harder to understand, and it's it's just a little bit harder to actually look at and say, okay, this is what's happening in that underlying market. But it is important to remember that when markets are more volatile, when they are moving up and down really fast rather than being flat, clearly that is going to go into the pricing of this, right? Because if a market is going, like if we have a roller coaster market, that's going to be, okay, there's much more chance that this one that's up here might go down to here, right? While if the market's just sitting flat and the implied volatility, which is what the market kind of thinks the volatility will be in the future, if that is also flat, if that is low, the volatility is low, then the prices are going to reflect that, right? They're gonna be different if people think it's going to just go across like this, and it has been moving across like this, rather than going up and down and up and down like a roller coaster. So those are going to be the three main things, and I do have some examples here that I think will sort of illuminate these different pricing factors. So this first example, right? So we have our contract in here, euro dollar greater than 1.14 at 3 p.m. Right? So those are the three things we have. We have the underlying market, we have the strike price 1.14, and we have the expiration time 3 p.m. So let's say the expiration time we're going to say is right over here, and then this is going to be our strike price, right? So this is how the market's going to move up and down throughout the duration of the contract, but the strike price is going to be that linear price straight across. And so as we start kind of out here, this is still pretty close to the strike price, right? So it's just above. So you're generally going to get something pricing at just above 50. Because if you're pretty close to that strike price, but you're just above, it might be pretty close to 50, right? Because a 50-50 probability is going to be kind of right on the line. And something just below might be something closer to 40, right? And this is also, when I'm talking about these probabilities, kind of looking at the buy side price, right? So we have 54 on the sell side, 58 on the buy side, right? But you're looking at sort of that buy side probability, that midpoint. Obviously, if you flip it, then it's the inverse of the sell side. So we have right above 50 if it's above strike price, right below 50, in the 40s if it's below that strike price. But we still have a lot of time left, right? So there's a lot of time to move. So at this point, the relation of the underlying market of the strike price is a lot more important, if you will. But as the time keeps ticking on, you might see that, look, these are very similar. These are very similar in terms of price, but now we're getting a lot closer to the end of the contract. So as you get kind of closer to the end of the contract, what starts to happen with the pricing is it tends to sort of drift away from the middle because that time is getting more and more important. You have less and less time to be right. Basically, you have less and less time for the market to go in the direction you want it to go in. So the pricing is going to start moving away from that kind of middle 50-50 pricing. So back here, we have much more, times out a huge factor. We have a much longer kind of runway, and it's a lot closer to 50-50 as you kind of move forward. That time starts to become much more important. Because you have less and less time for the market to move in your direction. And sort of similar thing again. So you can kind of see it bouncing up above the strike price. And again, you have very similar sort of points here. However, this is now priced at almost 20 20 kind of points higher, or the probability that this is going to be in your favor is sort of 20 percentage points if you will, more, because again, you have a lot less time for this to be correct. And this is just sort of showing as you go through here, it's going to keep sort of pushing that pricing a lot more volatile. The pricing is going to get a lot more volatile around that midpoint, just because there's a lot less time to be right. And then at the very end, you either have 100 or you have 0, right? So in this scenario, if you're on the buy side, you get that $100 payout. If you're on the sell side, you get that $0 payout, and because that's, you know, at the expiration of the contract. So very similar thing, and I'm going to go through this one a little bit more quickly than I did the last, but it's going to be a very similar example. So we have the same exact contract, but in this example, you can see here at the bottom that we don't have this upward and downward, above and below. We just are sort of sitting below that strike price for pretty much the duration of the contract. And so you're going to see a lot more sort of, you know, as you're earlier on, you still have that right below 50 in the kind of 40s, right? Because the probability is going to be, you know, just under 50%. That's going to be in your favor, and time hasn't sort of come in as heavily yet. And then as we go through the contract, you're going to see, you know, 30, 18, 0, right? It expires out of your favor for a $0 payout, again, if you are on the buy side. And a very similar example, we're just going to quickly go through, but, you know, if you're on top of it, you know, you have 50, 60, 70, 100, right? So this is going to be kind of that kind of converse. If it's above the strike price, again, you can see how time is affecting these prices. So I hope that was helpful, because I think it is a super important point to sort of understand when you're trading these. But I am going to, let me check the time. All right, we got a good 20 minutes left before we're up on an hour. So I'm going to go over and jump into the platform, and we're going to talk a little bit more about how to actually put on a trade, and how to. This is a little bit more in depth in a couple areas that I think are quite important. So let me bring this up. So this is going to be the Nadex.com. If you don't know how to log into the platform, you just want to go to Nadex.com, and if you have an account, you just click login. This is the login screen, and I'm going to log into my demo account. I have my I like Nadex demo account, because I do like Nadex, and I guess I'm a little biased. So this is going to be the platform as you first get into it here. And I do a few platform webinars. So and I think not next week, but the week after, I will do a platform webinar. So if you want to come back, learn more about the platform, come to that. But just for this example, we're just going to be looking at the binary options. So we have our 3 kinds of contracts at the top left. We're going to keep with the binary options. And what do we want to trade today? So we have all of our market classes that you can choose. We can do Forex. Forex is fairly popular. And euro dollar, we were just doing a euro dollar example, so why not keep going with euro dollar? One other thing, so kind of how you get to the contracts themselves. If you want Forex, you click on Forex, and you see all of the available underlying markets, as well as all of the different time frames. So we do offer a lot of different time frames. So throughout the day, you can get different contracts. If you want to trade something that expires in 24 hours, you generally have that option. And then we do have, you know, ones that expire in an hour, 2 hours, sort of rotating around the clock. So for right now, I'm going to get into this 12 p.m. to 2 p.m. contract that we have about an hour and 20 left. So as I click in, I'm going to see all my strike prices, and I'm going to see all of the pricing, right? So these are our strike prices on the left that we were talking about earlier, and these are the different pricing that's going back and forth, just like we were discussing. And so before I even get in, I know that this one right here, this 11474, which is pretty close to a 114 example we were looking at, I know this one's probably going to be right around where the market is, because you know, it's pricing right around that $50 point. So if I click it, we'll come up here, and actually I'm going to take these indicators off so you just everyone can see, and let me just really quickly so everyone can see these strikes. So we have our strike selected. So we see on our chart here that, yep, we're right. We're very close with this contract right here to the underlying market. So we have our underlying indicative price here. You can see it on the chart. You can see it on the side at 114,748. And this contract is, will euro dollar finish higher than 11474? So it's right now it's trading at just above the strike price. And as you see, as we move up and down these, just like we were talking about, as you get further away, as you get further above these, they get, the cost to get in gets a lot less because you need this market to move a lot more to be in your favor. And as we go further down, it costs a lot more because you would need the market's already in your favor and you need it to move a lot against your position. I have a question here. Would you the question is, would you not have options trading for equity and binary trading, please? I'm not exactly sure what you're asking. If you could, sorry about that. If you could rephrase that again. Because we do, if you're asking if we do have equities, we have equity indices. However, individual equities like individual stocks, we do not have, and that sort of goes down to our regulatory status. Although we, never say never, we have looked into them in the past and continue to look into those. So maybe one day, but for the foreseeable future, we won't have individual equity options like trading a binary option on a Tesla or something. However, you can trade on the US 500. So we have our chart here, and so let's get into one that's right around the where the contract's currently trading, right? One very close to that sort of middle 50-50, or this one's actually now closer to about a 60% proposition. So you can see these best available prices moving up and down, and as we talked about, we have our proposition. This is the underlying question that we are being asked in this trade. Will euro-dollar finish higher than 11474 at 2 p.m. today, right? So we have our at 2 p.m., that's in 1 hour and 17 minutes. We have our indicative price. Okay, we're already a little bit above this. And we have our kind of pricing. So I have my sell side. And one thing, if you click sell and buy, it should sort of shade above and below on the chart so you can get a little bit more visual representation of what's going on. And actually, while I'm doing this, I'm gonna turn off the rest of the strikes so just we can focus on the one strike that we want to focus on. So as I go down here again, we have our order type. We have and we do have our two different order types. We have our limit order type and our market order type. And I will real quick in a second go into what those are, but I do want to show you. You can see the rest of the prices on the exchange. So I said earlier, these are the best available prices. These are the best market prices sort of being offered up. However, if you go to look at the show market depth, you can see that usually there are actually other pricing below the best pricing on the exchange. And in fact, these actually look like they're primarily our market makers right now because they're larger lots, but you can, as an individual trader, put a contract out there and actually see it show up on the market depth. And I'll show you how to do that. So we have our order type here. This is limit GTC. I'm going to go really quickly go over the order types. So a limit order is basically you're just choosing what price you want to pay. Now that doesn't mean that you can choose any price, right? Like this costs $64 to get in. I can go ahead and say I want it for 20. That doesn't necessarily mean, and in fact, it won't mean that I get that right now for 20. What I'm really saying is, if the best price goes down to 20, then get me into that contract at that point, right? So I can choose a price, but I've actually hit place order, and I'll show you just really quickly. It won't go to my open positions panel down here. It'll go to my order, my working orders. And basically what this is saying, what I've just done is saying, if this market gets down to a point where the buy side is pricing at 20, get me in then, but I'm not actually into a trade yet, right? I just sort of put an order out there saying, if it gets down there, get me in. And actually, if I go into the market depth, well, there's my order, right? This is my order sitting right here. Oh wow, we just had this break through the bottom, and actually, I think I might have just gotten filled. Yep, I did just get filled. Look at that candlestick. What just happened in the euro dollar? So these can move fast, right? That's actually a very good live example of how fast these markets can change, because we were all the way up here, and then we just have one 1 minute candle that's slamming through the floor. Something much just happened with the euro dollar, but we were just priced like $60, and now we're pricing a little bit closer to 16 or so. So it is always something you need to be aware of, right? With trading binary options, that large market moves can very quickly change the value of your contract. Wow, we really had that was a huge, very red candle. So that just dropped through the floor. And so if I go back to our different order types, right, we can also look at our market order. Market order, you can see the price disappears, and basically what you're doing with the market order is saying, just get me into this contract at the best available price that is currently present in the market. I don't care if I have, I don't really care what that market price is. I mean, I care what it is, right? But get me in at sort of this price or right around this price, right? Because again, when you put in a market order, you are, there is a brief kind of milliseconds while the exchange is communicating back and forth. And so you're getting in at basically the best market price that you can get in that it can tell you about. So if I just want to get in this, I can also press place market order, and you can see now I have two of these. And actually, I'll get into another contract real quick so it's a little bit more clear what I'm doing. So and you can also see here actually, so I was, this is actually a really good example of this volatility metric that I was talking about earlier. So let's bring it back up, all the strikes. You can see even though this is, wow, what is, wow, we really have really leap down in euro dollar. Some news probably just came out because this is a very big drop. I mean, this is yeah, it happens. It happens in forex. It's not necessarily abnormal. It happens in actually every market. But you can sort of see that even though we're pricing pretty close to above, that because of the volatility we just experienced, that it's still not necessarily even a 50-50 proposition because man, look at this drop. Yeah, so we really have a very large drop in the euro dollar. This is a great teaching tool. I'm very glad we're getting this during a webinar. But you can sort of see that, right, that volatility is just going through the roof because this has just moved a ton, and therefore it is affecting the pricing as well. So you can see even before some of these prices were coming in, that it was sort of pricing in that volatility a little bit and not actually giving you that above $50, even though it was above that sort of strike price, because the underlying market just got so volatile that those prices kind of go and get a little bit wider. Yeah. Under for individual equity. I got you. Okay. Yeah. So I had a clarification on that question. It was, can I trade equity options under binary for individual equity? No, not at this time, and probably not in the near future. Although that is something we're always looking for. So going back over here, so we have our limit order still, and I can kind of get into another contract here because I want to show. Let's maybe do something with a little bit less volatility right now. Let's see, how is see if the volatility is just in the, oh yeah, looks like something just happened with dollar pricing, because it looks like all the dollar pairs are going through. Let's see how Aussie yen looks. So everything in forex is kind of blew through the strike. So another thing that happens sometimes when this happens is we have to add more strikes, and probably some of our operations guys are going and adding a bunch of strikes right now to these. Let's get into an index though and see if, yeah, so now we have looks like everything dropped across the board. We're going to do a daily index though and see, yeah, we really had a sell-off, kind of lunchtime sell-off there. So let's get into a market price real quick. We'll get back in, but before I do actually get in, I do want to show you again this is super important. This relation between max ROI and probability of the money. So again, the maximum ROI stands for return on investment, and probability ITM stands for probability in the money. So in the money just means that it is in the money basically just means that it's in on your side, right? That at expiration, if you're in the money, that means it expired correctly for you, right? So if I was on a buy side and it expires above my strike level, that would be called in the money. Same for if I have a sell side contract and it expires below the strike price. Similarly, that's also called in the money because it is because I'm in the money, I'm in the payout, right? OTM would be out of the money. So just some terms, but So we see here though, right, as this prop max ROI moves up, the probability of the money is going to move down, and same thing. So I'm going to click around here a little bit. So I wish I actually had one that was closer to like a $90 contract, but it looks like everything's blown through. Here we go. Well, let's get on the small caps. So on the small caps, I still have some contracts down here. So right now I've selected like a $94 contract or a $90 contract. So very important relationship here, right? So my max ROI is only like 6-7%, right? And that's because how this is calculated is I am paying about $90 to get in, right? And my potential max profit that you can see here would be about $9, right? So let's say it's just 90. So I would pay 90 to get in, and $10 to get out. So my maximum ROI on that is going to be just around, just under 10%, right? Because it's a relationship of how much I'm paying, how much I'm risking, to how much my profit's going to be. And so you might say, well, why would I ever get into something that I'm paying 90 to get into and I'm only getting 10 out of? Well, that's because you have a much higher probability of that expiring in your favor, right? So you can see, because I have a way higher probability, it's going to cost a lot more for me to get into that contract, but I have a way higher chance. So as we just saw, yes, these can drop really fast. So it's not a 100% chance ever. Nothing is guaranteed in any financial markets. And if anyone ever tells you it is, you should say that they're lying to you and run away, because there's nothing ever guaranteed in terms of like a profit or loss. But you have a much higher chance when you're down here, because the market would have to go, let's turn this on, the market would have to go all the way down here to be below and for you to not receive a payout, right? And similarly, if I go and choose one that's all the way up here, well, now I'm only paying, now I'd only be paying, if I'm only paying $14 to get into this contract, my max ROI is 500%, 600%, right? So you might be saying, well, I always want to do a max ROI with 600%. But again, you got to look at the probability, because yes, if this goes all the way up here, you're going to get a huge return on your investment, because you're only paying like $14, and your potential profit on that is right around $85, right? So that's a huge return on initial investment, 500-600%. But the probability that this happens is very low, because it's very far away and you don't have that much time. You only have about 3 hours. So that's sort of the relation here, and why you want to understand these relationships between why I might want to get into a contract that's priced at like $90 that I can only get 10 on, or why you might want to do a riskier trade that you're paying $10 to get in, which you're not actually risking that much money, but it's riskier in the term that the probability that outcome happens is a lot lower. So I do have another question here. Okay, so this question is, when will OSO orders be offered? Or I'm assuming you're also talking about OCO, OTO. So the question here is really, when are more advanced contract entry and exit order types going to be offered? And that is something we would like to do. We have been planning to do it. Basically, we are doing an overhaul, not to get too into the technical details, but we're overhauling part of our system so that we can offer those. Is the sort of short explanation. I do really want to offer those, and I've sort of written up some pitches to actually get those in. We've done sort of estimates to how long those would do and what we need to do them. So we want to get them in. However, right now we're working on different parts of the exchange to sort of get those in there. But hopefully, within the next year or so, those are extremely useful options, and I do really want to get them in there. And for anyone who's not aware of what these are, they're basically saying something like, I can put a limit order and a stop order, and if the limit order triggers and it cancels my stop order, or something like that, right? Or if I have 2 limit orders in and I only want one to hit, then once one hits, it cancels the other one. Basically, more advanced order types that allow you to set up a trade and not actually have to maybe manually monitor as much. And so we are working on those. However, I do not have a timeline for those right now. I'm just trying to be as honest as I can be. But I do really want them to get in there, because I actually use those in my trading as well on other platforms. One other thing that I do, we've put on a couple trades here, and I do want to harp on here before I know we're getting into sort of the end of the hour. Couple more things. So first of all, we can see here. Let's go back to this example. So I right now I'm in this contract and I'm in the money, right? So, or sorry, I'm when I got into I'm not in the money, right? So if this contract were to expire right now, and I think actually what just happened here on this on in this market is a really good example of what I always try to um, tell that happens with these. So that 100 to 0 payout, that kind of binary payout of either you get $100 or $0 at the end of the contract. That's only true. That's only the two options you have at the very end of the contract, right? At expiration. And so a very important thing to look at when you're looking at your profit and loss is the profit and loss you are seeing right here, right? This profit and loss is only the profit and loss that you will receive if you exit your contract right now. It is not the profit and loss that you will receive if the contract were to expire right now. And so that's a huge difference. So, and this is a super good example of this that just kind of happened to get into here. This profit and loss, right now I'm profitable. However, I am on the buy side of this contract. So I know this is ticking out. I want to make this point fast. If this were to expire right now, this market is still underneath the buy side, right? It's still underneath that strike price. So, and I am on the buy side. So if this were to expire right this second, I would get a $0 payout. I would lose what I initially paid to get in. However, my profit and loss is positive. Why is that happening? Well, it's because I got into these contracts when I was down here. So from the time that I got into the contract to right now, the market has moved upward a lot. Therefore, my contract is more valuable. So again, if this were to expire right now, I would get a $0 payout. I would lose what I paid to get into the contract, and I would take a loss of however much I paid to get in, 28 bucks, I think. So average 14 price on 2 contracts. But I can sell out of these right now, take my profit, wash my hands and say, okay, we're good. And on something like this, I actually might want to do this. Might be an example when I really want to do that because, you know, we've just seen the market move heavily up back in the direction, but it's still pricing around a kind of 50-50 level, right? It's still very close to my strike price that I had selected earlier. And so I might want to actually just get out, take my profits and say, I'm already profiting about $20 per contract because I'm in 2 contracts on these. I can get out, take that contract, use those funds to get into something else, and I'm not sort of in this sort of almost 50-50 proposition or just under that anymore. So I can hit this close button down here, and I can say, okay, I have my 2 contracts. It's going to tell me super clearly I paid 14 to get in around as average, and the current market price is about 28. And one thing to remember, when you exit your contract, you exit on the other side. So if I'm on the buy side, the price you're looking at to exit is the sell side price. If you get it on the sell side price, the price you will be looking to get out is the buy side price, just always something to remember. So I can go ahead, close my position, and this is automatically going to get me out of the best available market price, and I'm going to take my $30 profit, wash my hands. There we go. Nice profitable trade, right? But that is something I always want to harp on is that the profit and loss you were showing at the bottom is not your profit and loss at expiration. There are many times when you can be like what we just saw, where if it were to expire right now, I would lose money. But if I were to get out right now, I am in profit. The converse is true as well. If we had the opposite happen, right? If the market just shot up and now it's coming back down, I might and I had gotten the kind of price way up here and it's coming back down. Well, my position might be showing that I'm in a very large loss position. However, if it were to expire, all I care about at expiration is above and below this line, right? So that is always something I do like to harp on there, just a little bit. That is really, I know we just hit kind of our hour point here, so and I think I went over almost everything that I wanted to cover in this webinar. If you do have any questions, I'm going to stick around for another 5 minutes or so. Just if you have any questions, I have the chat over here, so feel free to throw those in. I'm going to throw up another slide here just with some of our different socials where this is going to be posted. but thank you all. If you are sort of done, if you don't need any more help, thank you all for hanging out for the last hour or so. I know I basically just talked your ear off for the last hour. I really hope it was helpful. Oops. If you do have any questions, comments, concerns, throw them in the chat right now. I will help. I will go ahead and answer those. This recording will be up on our YouTube channel directly after this, so in a couple hours. Here are all our socials. Definitely go ahead and follow us on them to stay most up to date on what's going on. So we, Twitter, Facebook, Instagram, all the good ones, all the big ones, right? And if you do need help after this, you can send an email to customerservice@nadex.com. I know everyone on that customer service team, they're very helpful. They should be able to answer all your questions. You can also live chat them as well on the platform. And if you are enjoying Nadex, you can go leave us a review on Trustpilot. It does help us out. No problem. And thank yous coming in chat. Yeah, I really hope this was helpful. I always do try to make it as helpful as possible. One other thing, so I think actually this is signed up as a series now, so you guys should get invites. So I basically do a series of 4 of these webinars, one after another. So I believe, so this week was binary options. Next week I'll be going over a very similar webinar that does the basics of call spreads and knockouts, I believe. There are 4, so sometimes I mix up the order of them, but I believe next Thursday, same time, should be call spreads and knockouts. Thursday after next, same time, should be an overview of the platform, how the platform works, going kind of in depth into all the functionality that's there. And then the 4th week will be charting, so going very in depth into charting functionality and everything that works inside our charts. If you do want to go look at any of the previous ones I've done, you can go look at the YouTube, and also we do have some a little bit shorter form videos. They're not all an hour long on some helpful YouTube videos there. So I'll give it one more second for any questions. I'm not seeing any come through. Hopefully I was able to answer most of them as we went through the chat here. All right, well, I think I'm gonna end it here then. Yeah, again, thanks for coming. Thanks for hanging out with me and letting me talk your ear off for an hour. I really appreciate always talking to everyone. I do have a question out there. Is there a video out there now on how to use the platform? Yes, there is. So you can either watch one of the webinars that I give on a monthly basis. So if you go to our Nadex YouTube page, it should just be called, oh, I'm not sure if I know what it's called. You know what? Why don't we just go to the YouTube page right now? So you can go over and youtube.com. Let's go to Nadex. Yeah, this should get out in here.
Go on.
That was loud. So I believe this should come up with the shorter one. So this is going to be kind of the shorter the shorter one. There's also there's longer tutorials as well. So there's the kind of the hour-long one that I do as well. So if you search on here, this is going to be kind of a shorter. How long is this one? About 3-minute video that either I did or our head of education did a couple years ago. That should be a good one. And then if you look in, there should be a sort of an hour-long video as well, similar to the one I just did that I give. Or come back in a few weeks and I'll give one then. You can ask questions on that one. All right, I think that is all the questions today. We're about 12:05, so I'll go ahead and call it here. Thank you all so much for coming, hanging out for the last hour. I hope all of you have a wonderful day, a wonderful week, wonderful month, wonderful year, and best of luck in all of your trading going forward. Have a great day, everybody.